In this week's update, commentators who are misleading you, a clear market perspective, and precious metals still. My name's Garry Davis, and as always, this is general advice only, and please like and subscribe to the video. All right, a lot to talk about this week. There is an absolute avalanche of negative commentary out there from mainstream about how ridiculously overvalued this market is. And I really want to put a focus on why you've got to switch off from all of that normal market commentary, because it really is misleading you. So let's just run through some of the key aspects of this. The tools of the mainstream commentators are things like PE ratios, and there seems to be a feeling out there that the PE ratio, if it goes above 20 or 25, then it's a bad thing, but it's being taken out of context. Something like the Cape-Shiller ratios, which I've spoken about many times before, which are a backward-looking valuation methodology. So why you would use that is completely beyond me. And these commentators will tell you that markets are wildly overvalued and that there's danger around every corner. And I know, because I get to talk to a great number of traders and investors, and a lot of people out there are concerned and they're apprehensive about what they read and what they hear. So these commentators are certainly not doing anyone a service by trotting out some of these old ratios that frankly just do not apply in this current day market. And what they don't say is that markets tend to look forward, not backwards. And a lot of these things are about looking backwards that you're being given through the mainstream media. Markets look forwards. And I'm going to show you some examples of just how graphically markets do look forwards. And right now, if you step back and think about it, PE should be high for stocks that have got growing earnings when bond yields are as low as they are. It would be highly unusual if PE ratios were not high. And again, I'll give you some examples on this. And many stocks do something completely different to the indices. And that's probably one of the key points that I really want to get across, is that this is a stock pickers market. This is not a market that you should be trading or paying attention to the index. And if we just think about stocks like A2 Milk and Fortescue during the crash in February, March, they actually went up, not down. So quite different from the rest of the market. And if we look at stocks like Apple and Amazon, how they've performed in recent months, and in particular Apple on Friday night, is just something to behold. So let's take a look at some of those charts just to put it in perspective. So I'll just start with A2 Milk first. So there's A2 Milk. Here is the period from February to March. So here's the crash. The crash in global markets occurred basically from there to about there. That was the crash. Look what A2 Milk did. It actually went up and then it kept going up afterwards. If we look at Fortescue Metals, the crash period was from roughly here to about there. Yes, it dipped for a week or so, but then it just rebounded again quite strongly. Now let's look at Apple and Amazon. Yes, Apple had a decent dip during the crash period, but look at what it's done since. It's gone from $230, peaked out just under $400, had a couple of days down, and that was really what I talked about last week, the turnaround that we saw at the end of last week that looked like it could be a topping process. But look at what happened with Apple's earnings on Thursday night and into Friday. Now, if we look at Apple at the moment, the 2020 PE, that's this year's PE ratio, is 32. That looks expensive if you use traditional metrics. And their earnings growth rate, if we look from 2017 to 2022, so that 5-year period, so yes, that's taking estimates for the next couple of years, but analysts are all over this company and they're generally not too far from the mark. So we're looking at an earnings growth rate of 14% per annum. Now, a lot of people will look at that in the traditional lens and say, well, that's expensive. But let's look at it another way, the way that the market is looking at it. The dividend yield, that's the actual cash that Apple is paying out, is 0.9%, and the earnings yield is 3.1%. But if you don't want to be in a stock like Apple, then you could go to bonds and you could go in the 10-year Treasury yield and get 0.55%. So which would you prefer? And it's quite clear what the majority of investors do prefer, because the price just keeps going up. So if you listen to the mainstream commentary about how wildly overvalued markets are and how dangerous they are, then I hope you remember this analysis, because this is the analysis that the market is currently using. It's not this analysis. It's not the old analysis based around Cape-Shiller ratios and PE ratios. Let's look at Amazon. Amazon hit a low of 1,700 during the crash. Now it's trading at $3,200. It's almost doubled since the crash, and there's a good reason for it. Because these businesses are actually beneficiaries of this new environment. They're a beneficiary of the COVID-19 environment. So why wouldn't you just trade them? Why would you worry about the index? And why would you worry about what mainstream commentary is saying? So I hope I've made my point there. I just want to touch again on secular and cyclical bull and bear markets, because I had a few questions through the week, and it seems that there are some people that haven't quite yet understood that concept and where we are. And I guess it's because they are absorbing some of this mainstream commentary. So I just want to pose a couple of questions. How do we know which we are in? How do we know when they change? And the answers to these aren't all that simple and clear cut, but if you take a step back, they become much clearer. And finally, and most importantly, what do we actually do about it? And it's really about being responsive to a pre-constructed, simple game plan, and it needs to be simple. So there's nothing particularly incredibly smart about this. The game plans can be really quite simple. It's much more about discipline and understanding what stocks you want to buy, which are the growth stocks. Know what price is a possible target. So have a bit of an area and see what the price action looks like when it gets back to that area. And build a large target list. A lot of people have far too many stocks that they want to, far too few stocks, I should say, that they want to get into. And that causes them to chase prices. So if you've got a big target list, then you can just sit back and wait for what comes to you on your terms. And that is the way to trade these kind of markets. So you've got to be extremely selective, and you've got to have all your ducks lined up in advance. So what are our tools? What are the tools that I use every day? Well, it's price and volume charts. It's relative strength analysis. And I touch on these points regularly. It's understanding the real drivers of price action, the activities of market makers, the forced behaviour of fund managers, the telltale signs when fund managers are accumulating or distributing stock, just human psychology, what causes people to do what they do in the market, the interplay between the stock and the options market. These dynamics all have an impact on driving prices. And if you don't have some sort of understanding of these things in the background, you don't have to understand them intimately, but if you've got at least some overview of these contributors to how prices move, then if you don't have that, you can misinterpret the price action in the short term. And that can cause you to either not buy something or to sell out of something, or basically take the wrong decision. So it's about clear thinking, independent analysis to identify where the revenue and earnings growth is going to be, and where that revenue and earnings growth is almost certain. Nothing is guaranteed in life, and certainly nothing is guaranteed in the market. But there are sectors and stocks out there where their revenue growth does look to be pretty close to a no-brainer. And then we've got to have the discipline to trade what we see and not what we think. And again, I still get lots of commentary and lots of questions from people that are working on gut feeling. They feel like the market should go down, or they feel like the market should go up. Well, guess what? It's irrelevant. The market couldn't care less what we think. So you need to be prepared to be responsive. Yes, there are some false starts, and I've called a few false starts in the last couple of years. The first one I remember was when the market broke down or appeared to break down in 2016. And I quite clearly called that the market had topped. But then 2 weeks later, it had reversed. And so I reversed my position. And that's how you need to approach the market. You need to be flexible, and you need to be able to change your opinion very, very quickly if it's supported by what you see in the market. And just simply think in terms of risk and reward and probabilities. So you've got to get yourself outside the emotion, get yourself outside what you think it should be happening, and just think in those terms, and you'll do far, far better. All right, let's look at American stocks. The S&P rose 1.7 for the week. Technology earnings were only down 2%. Now, they've absolutely belted top and bottom line estimates. And what that's telling you is that analysts had become too conservative. They'd become too bearish. And they were expecting far bigger drops in earnings than what we actually got. And that's why Amazon and Facebook and Apple did so well at the end of last week, because even though the earnings may not have actually grown all that much, they certainly were much, much better than analysts were expected. And the forward guidance is also looking pretty good as well. So 83 out of the S&P 500 stocks have reported so far. 67 have beaten estimates on revenue, sorry, that's on earnings. 30 have actually raised guidance. So they're now guiding the market higher, which is indicating confidence on the part of those management teams. So we just buy them when it's appropriate. So we know what stocks are doing well. We don't want to buy them when the price has just shot up. We want to buy them when the price comes back a bit. So tracking indices, really, if you're taking your cues from the ASX 200 or the S&P or the NASDAQ or whatever it is, then you're using the wrong signal, because tracking the indices has largely become irrelevant. It's very much about tracking individual stocks. The indices really just set the sentiment tone for a few days. And yes, it can have an impact on most stocks for a day or two, but the good ones just quickly get back into their stride. The US dollar continued its breakdown. We did get a turnaround though on Friday night, which was quite meaningful. So we may have seen the short-term lows in the dollar, and it ended up down at 93.46, but it actually dipped under 93. So let's take a look at the S&P. So first of all, I will just go to the bigger picture chart and just look at this secular and cyclical bull and bear markets. Now, I've done this quite regularly, but there's plenty of new subscribers to this particular weekend video, so I'll just cover it again. So from here to here, which was 2000 to 2012, 2013, was a secular bear market. Big picture, that's what secular means, big picture bear market. And within that bear market, we had a 1, 2 cyclical bear markets. So they're shorter term. This one in the early 2000s lasted 2 years. This one around the GFC lasted 18 months from top to bottom. But we also had 2 cyclical bull markets. One that ran for about five years. And then we had another one that lasted another 3 years before we actually broke out. And now we are in a secular bull market, so a big picture bull market. And at this point in time, it is not completed. And typically, secular bull markets run for anything up to 20 or 25 years. This one has been running for 7 years. There is no reason, this is not a prediction, but there is no reason why this could not continue for another decade. Now, let me repeat that, because I don't want people to take my words out of context here. This is not a prediction. It is just an observation that we are in a secular bull market, and that based on historical trends, this could continue for another decade. However, let me add that there will be cyclical bear markets. There will be episodes like this, although they do seem to be getting shorter. We had one here at the end of 2018, when it looked like interest rates were going to be being tightened by the US Fed. and the market hated that. So we had a cyclical, almost cyclical bear market. It wasn't quite. It was, the index on official terms was down 19.7%. So it didn't quite make it. 20% is the official cutoff. But for a lot of stocks, they were in a bear market during that 3-month period, but it was very short. Now we've just had another cyclical bear market. But guess what? It lasted 1 month. That's it. Finished. But it's still, because it went down 40%, it's a cyclical bear market. And I can almost guarantee you that we will get some more of these. Hopefully not as sharp as March, because we were hit with something unexpected that's never ever happened before, where the whole global economy was just basically shut down without notice. But I'm almost certain that we're going to see more events like this, like we saw in the early 2000s and in the GFC, even though we are in a secular bull market. So it's just a matter of having a game plan that recognises where we are. Sometimes we're going to have to react to short-term moves in the market, and that will create some false starts. But that's just the way that it works in the market. And if you don't particularly like that, and if you don't want to work with that, then you probably shouldn't be in the stock market. Okay. The 10-year yield was also lower to 0.55. Sorry, let me go back to the S&P because I didn't complete that. All right, so here's the S&P index just for the record. We have now broken above the June peak, short-term high. We then got a period of consolidation, which is normal after such a rapid rebound. And we're now only a few percent off the all-time highs that were formed in February. So there's every chance, particularly when we look at the earnings results that are coming through, there's every chance that the S&P as an index can set new highs in the next few months. But as I said at the start, that's really irrelevant because we're not trading the index. There are so many stocks that are either breaking out to new 52-week highs. There are hundreds and hundreds of them. And there are so many stocks that are already at significant new all-time highs, and they keep setting new all-time highs every week. So we focus on those stocks. US dollar, clear breakdown. I suspect we've still got further to go yet because we're not down to resistance, and we could go as low as 80, 88, 89 technically. But quite a nice turnaround on Friday. So I suspect we'll get a bounce. We may get a bounce to this resistance, which is about 94.5. And this is a market, whether it's stocks or currencies or whatever it may be, that is being driven by technicals. There is no question. It is just so obvious that computer algorithms are what's driving this market at the moment. So I wouldn't be at all surprised to see the US dollar bounce up a little bit further and then probably turn down again. Now, the consequences of that for the Australian dollar is that we've now managed to sustain a breakout from this trading channel that we had going back to June of last year. So I suspect the Australian dollar will probably weaken if the US dollar strengthens, but then we will follow that. So we could see some more Australian dollar strength yet. Turning to Aussie stocks, 71.3 is where we finished. Our index was down by 1.6 on the week, 1.6% on the week. But look, it's the new economy stocks that are really moving, and there are some very, very large moves. Now, these are examples only just of price patterns. I certainly wouldn't be entering these stocks at the moment. But these are all examples of new economy stocks that have got tremendous futures ahead of them. But the price moves have been absolutely eye-watering in the last little bit. And so I want to show you just a couple of those examples. And I want to contrast it to some of the stocks that traditional portfolio thinking would have you buy. Stocks like Woodside, Westpac, or Sydney Airports. So let me just let the pictures say 1,000 words and ask you to consider which sort of stocks you would prefer to own. So let's start initially with some of these new economy stocks. So this is Whisper. I'll just run through these very quickly. I just want you to take in what the price chart is doing, what the trends are doing, and what the price chart is doing. This one has moved from $2 to $5 in just a matter of a few weeks. This is Sezzle. It's moved from around $2, got up to $9, again, just in a couple of months. NXT, which is certainly part of the new data center revolution, if you like, that's occurring around the world. And if we look at Marley Spoon, which is really picking up on this global move to home deliveries of meal kits, this is a structural change in consumer habits. It's not going away anytime soon. This is not just a flash in the pan. Now, you wouldn't want to buy it here, but has this company got an exciting long-term future? You bet it has. Now, the alternative is that we could go and buy stocks like Woodside that are doing that. In January, they were trading at $35. Now it's trading at $20. We could go into a stock like Westpac as an example of one of the banks. I don't think I need to say too much more about that one. And the dividends have been reduced. Or we could buy a toll road, one of the infrastructure stocks like Sydney Airport. It was trading in January at $9. Now it's trading at $5.20 and looking like it's going lower. Now, it was yielding 4.6% at December, and so a lot of people were buying it for the yield. But guess what? The dividend's been suspended for this year, and who knows when it will come back. Plus, on top of that, the fact that you're no longer getting a dividend, you've got a major capital loss on your hands as well. This is what traditional portfolio management and traditional thinking would have you doing, rather than owning stocks that are doing this. Here's another example. Z1P, for instance, just as one of many, many examples. So I'd really urge everybody to think about what it is, the signals that you're using to trade and invest in the market. And ask yourself whether you're in step with the way that things actually are now, or whether you are using older methods and ways of thinking. All right, precious metals. Gold had another stunning week, up $73, finishing at $1,976. So we've now broken out to new all-time highs. July was just an incredible month. It's one of the strongest months ever. It's normally a weak month. Normally June and July are two of the weaker months of the year because of seasonality, because there is just less buying for the Asian harvest season and the Indian wedding season. They are big drivers of gold demand. So June and July normally weak, and we've had one of the strongest Julys on record. The good news is that we're now entering, and this makes it tricky because markets are overbought, they're extended, but we're now entering the normally strongest period due to traditional buying patterns. So the Asian harvest season is going to be kicking in soon. So it's going to be very, very interesting to see what happens with gold, having come out of probably the weakest period of the year in incredible strength. GLD holdings continue to soar. This market is still being supported by investors, which is what you need for the trend to be sustained. And plus, clearly, speculators are now coming into the market as well. Precious metal stocks, they're showing some minor caution. They're not quite as robust as you would have expected, because we would expect gold stocks to amplify the move in gold by about 3 to 4 times, and we're not seeing that. So there is still a bit of caution there. Now, last week I said do not buy precious metal stocks now, and despite what's happened, the fact that gold went up so robustly, silver went up as well, and GDX went up, I still think that was the right call, because you've got to have discipline in buying into short-term weakness. Otherwise, you're just really asking for a bit of trouble. The weakness will come. There will be some pullbacks in gold stocks, so just wait for them. It might be next week, it might be next month. But have the discipline to buy into that weakness. All right, let's take a look at gold. So there's gold on a weekly chart. So big picture, all-time highs. Here was the peak in 2011. at just a tick over 1900. We've now absolutely blasted through that, basically without stopping. You can see there was no stopping at resistance either here or here. It just went straight through it, which I find absolutely incredible. We're now well and truly outside the trading channel. So again, this is what just sort of concerns me from a technical point of view. We are so far outside the channel that I'm just a little bit concerned about a near-term pullback. But at the moment, we're not seeing it. So as I said, I wouldn't be buying. You need to perhaps think about taking a little bit of partial profit, but you still want to retain some pretty healthy exposure to the gold market. Trade what you see and not what you think. The market is going up. So stay with the majority of what you've got until the market shows us that it's going to roll over into a period of weakness. Let's look at silver, because it's also done very well. So there's silver. We're now in breakout territory on silver as well, and finished very, very strongly on Friday night. Now, if we look at GDX, this is a weekly chart. We've got a very clear breakout now. But as you can see, as opposed to gold, which is at new all-time highs, GDX is still way, way below the peak in 2011. There is still plenty of fuel for this to play catch-up, just to get to where gold is now. And if gold keeps going up, then the catch-up just needs to keep accelerating. So the outlook for precious metals, there will be some sharp pullbacks. So, don't think this is just going to go straight up. There will be sharp pullbacks, but the outlook for precious metals is very, very strong. All right, other commodities. Copper eased a little bit. That's really just US dollar turnaround on Friday, and that's the same with crude oil. There's the spot copper chart. So we've certainly been in a very strong uptrend since March, which is reflecting expectations that the global economy is not going to be too badly off. And we're certainly seeing that now in some of the economic data. It's coming through better than what people expected. So the price of copper got crushed because analysts expected things to be doom and gloom, which is what they traditionally do. And the market overshot to the downside, and now it's coming back to meet reality. Just thought I'd look at nickel as well. Nickel is a terrific long-term story around, obviously, the electric vehicle and battery markets. But that's a long-term story. So, don't get too premature with copper and nickel. The outlooks are terrific on a 5-year view, but I don't know what the next 6 to 12 months might hold for these sort of stocks. Now, I thought I'd put up what I said last week. So I said these were short-term comments, so I was talking days or weeks. And I said there was some topping action in many US stocks on earnings. And we'll go back and look at the chart of Apple just as one example. I said there was clear evidence of distribution by the major players on intraday charts, and there was. And I said to expect a period of consolidation. Well, it lasted about 3 days, so I was wrong on that one. Well, not that I was wrong. That was what I observed. It was prudent to take some action, to take a little bit of caution, and to pare back some of your exposure and raise your cash levels. But it only lasted 3 days, so we immediately jumped back on the horse again. I said to expect the algorithms to generate volatility, and they certainly are doing that. So that was what I said last week. Let's just have a quick look at the chart of Apple. So there's the Apple chart. This is what I was looking at last week, before last weekend's video, and that was quite a sharp move in Apple, and that was reflected in so many stocks, large and small. It was very, very stark, and to not take notice of that and to just sit there and do nothing, I don't think is the right move. So I recommended to members that they do take some money off the table and cash up. But it only lasted a couple of days. We got 3 or 4 days of consolidation, and then bingo, out it went. But let's look at some other stocks. So this is Intel, one of the world's biggest semiconductor stocks. But look at what that price has done. So again, this is a market of two halves. There are the stocks that are doing really well, and there are the stocks that are doing really badly. And you just need to make sure that you're in the stocks that are doing very well. And it's not that hard to do. All right, so my final thoughts today. I know this has been a long edition, but hopefully giving you this perspective will help you in making decisions in the market. So this remains very much a stock picking market. You need to look for the companies that are thriving. And if you don't know how to do that yourself, which would be normal, most people don't have the inclination or the time to do it, then you need to align yourself with someone that does. So look for companies that are thriving. And then just simply focus on the price action of those target stocks. Don't worry about what the market's doing. Don't worry about what the press is telling you about what they think the market should do. And then you buy when the risk of further downside is limited. I go through this every week, but I need to keep reinforcing the point because it's easy for your head to get in the wrong space and get the wrong perspective on the market. You've really got to zero in and shut out the noise. So you buy when the risk of further downside is limited and when the upside potential is substantial. Now, we'll get it wrong some of the times, or it won't work out. Not so much that we get it wrong, it just sometimes it doesn't work out. But this is a game of probability and odds. And if you can get it right 7 times out of 10, then you're in extremely good shape. And that's the way you've got to look at the market. Not to try and avoid losses, just to manage them. And just forget about all the other stuff that's swirling around your head. All the baggage that you've accumulated along the way. And all of the what ifs that I know that a lot of people play in their mind. And what their gut feeling is about what the market should do or what logic would dictate. It's all irrelevant. Market couldn't care less. So you've got to try and put all that aside. Portfolio analyst this week, it's just a continuation of what we do. Every week I answer questions, provide a perspective on the market, inject some of my own recommendations, and basically stalking really good setups in the market. And last week I went through what portfolio analyst is as a service in detail, so I won't have any more to say about it this week. But there is a $1 trial for 2 weeks, and I think if nothing else, even if you don't stay as a member, I think the education that you would get during that 2-week trial will stand you in good stead. So I highly recommend that people try that. All right, that's it for this week. If you want to find out more, there is the website address and there is my email address for anyone that would like to communicate with me directly. That's it for this week. Cheers.